Hello friend, welcome back to our YouTube channel. Today in this new video, we will discuss on the topic of life insurance. Life insurance basis. Many financial experts consider life insurance to be cornerstone of sound financial planning. It can be important tool in the following situation. Number one, replace income for dependents. If people depend on an individual income, life insurance can replace that income if the person dies. The most common example of this is parents with young children. Insurance to replace income can be especially useful if the government or employers sponsor benefits of the surviving spouse or domestic partner will be reduced after he or she dies. Number two, pay final expenses. Life insurance can pay funerals and burial costs, probate and other estate administration costs, debts and medical expenses not covered by health insurance. Number three, create an inheritance for heirs. Even those with no other assets to pass on can create an inheritance by buying a life insurance policy and naming their heirs as beneficiaries. Number 4. Pay federal death taxes and state death taxes. Life insurance benefits can pay for state taxes so that heirs will not have to liquidate other assets to take smaller inheritance. Change in the federal death tax rules through January 1, 2011 will likely lessen the impact of this tax on some people, but some states are offsetting those federal decreases with increases in their state level state taxes. Number 5. Make significant charitable contributions. By making a charity the beneficiary of their life insurance policies, individuals can make a much larger contribution than if they donate the cash equivalent of the policy premiums. Number 6. Create a source of saving. Some types of life insurance create a cash value that, if not paid out as a death benefit, can be borrowed or withdrawn on the owner request. Since most people make paying their life insurance policy premiums a high priority, buying a cash value type policy a type policy can create a kind of forced saving plan. Furthermore, the interest credit is tax deferred and tax exempt if the money is paid as death claim. Types of life insurance. There are two major types of life insurance terms and whole life. Number one, term life. Term life is the simplest form of life insurance. It pays only if death occurs during the term of the policy, which is usually from 1 to 30 years. Most term policies have no other benefits provisions. There are two basic types of term life insurance policies: level term and decreasing term. Level term means that death benefit stays the same throughout the duration of the policy. Decreasing term means that the death benefit drops, usually in 1 year, increments over the course of the policy term. Number 2. Whole life permanent life. Whole life or permanent insurance pays a death benefits whenever the policyholder dies. There are these major types of whole life or permanent life insurance: traditional whole life, universal life, and variable universal lives, and there are variations within each types. In the case of traditional whole life, both the death benefits and premiums are designed to stay the same level throughout the life of the policy. They gets very high when the insurer lives to 80 and beyond. The insurance company keeps the premium level by charging a premium debt. In the early years is higher than what is needed to pay claims. Investing that money and then using it to supplement the level premiums to help pay the cost of life insurance for older people. By law, when these overpayments reach a certain amount, they must be available to the policyholder as a cash value. If or she decides not to continue under the policy, if the 1970 and 1980 life insurance companies into the dues to variation on the traditional whole life product. Universal life insurance is a variable universal life insurance. Some varieties of whole life permanent life insurance are discussed below. Universal life. Universal life, also known as adjustable life. The saving allow more flexibility than traditional whole life policies. The saving vehicle, called a cash value account, generally earns a money market rate of interest. After money has accumulated in the account, the policyholder will also have the option of alerting premium payment, providing there is enough money in the account to cover the cost. By the law, when the overpayments reach certain amounts, they must be available to the policyholder as a cash value if he or she decides not to continue with the original plan. The value is an alternative, not an additional beneficial to variations. In the 1970 and 1980, life insurance companies introduced two variations on the traditional whole life product: universal life insurance and variable universal life insurance. Variable life. Variable life policies combine death protection with saving accounts that can be invested in stocks, bonds, and policy money market mutual funds. The value of the policy may grow even more quickly, but involves benefit may decrease. If investments do not perform well, the cash value and death benefits may decrease. Some policies, however, guarantee that death benefits will not fall below a minimum level. Third and last, variable universal life. This type of policy combines the features of variable and universal life policies. including the investment risk and rewards, characteristics of variable life insurance, and the ability to adjust premiums at the death benefits. That is characteristics of universal life insurance. So thanks for watching our complete video and subscribe, and don't forget to press on bell like icon for more our interesting and informative videos. Soon we will meet in the next video.